Hi, welcome to Market Minute. This is where we analyze the markets, looking for opportunities, but most importantly, protecting the downside. So this is a big week. This is Jackson Hole week. This is where Powell speaks on Friday. He needs to deliver or the market's going to go down. So this is a little bit humorous. It reminds me of the movie where Will Ferrell has the Catalina wine mixer, the all-important Catalina wine mixer. Well, this is Jackson Hole week. This quarter is kind of a tough quarter. So seasonally, this is the tough months for the market in August and September, and sometimes it bleeds over into October. We have a market that's highly valued, and now the 10-year Treasury, the all-important 10-year Treasury, is going up in yield, putting pressure on the markets to come back down as the valuations get very tough versus the bond market. So if you look at what's happening in the stock market, we've been looking for a 5 to 10% pullback in the markets in August and September, and the S&P has gone down 4.6% from its high 4.9. The Nasdaq and the Russell have been a little bit worse. So the main culprit from all of this is a highly valued stock market and the 10-year Treasury now making that valuation too rich. So it's pushing the stock market down. The 10-year Treasury starting in August was 4.05%, a somewhat concerning level, and it's gone to 4.34%. So that's a 6.6% increase in the rate. If you look at what's happening in the stock market, it correlates really high with the decline in the stock market. 4.6 on the downside on the S&P, 6.6% increase in yields. It's almost identical to what's happened in the Nasdaq. So there was an interesting article in Barron's this week where some notable economists were talking about interest rates perhaps being higher from the increase in demand from Treasury borrowings and the global supply chain keeping inflation higher. So if the 10-year Treasury goes to 5% as discussed by these economists, then there's likely a meaningful pullback in the markets, could be as high as 20%. That's how the math works out. So looking at the technicals, so what's happening here? The blue line is the S&P 500. It broke the 20-day back in actually around August. Then it's blown through the 50-day. Now the next level is the 100-day moving average. And then support is down around 4,200 on the S&P. So we're a little bit below 4,400. And down here support 4,200 with the 200 moving average at 4132. So this is a critical week for the stock market, but probably more importantly, September is as important or more important than what's currently happening. The Fed will set the framework for interest rates going forward on Friday. So this is what Chairman Powell is dealing with. And every single interest rate cycle that has occurred, we only go back to 1955 for this, but they all look the same. The Fed increases rates, the economy goes into recession, and down below here you can see the unemployment rate. The unemployment rate spikes up. That's what kills the inflation. Powell knows this is where he's headed, so how he's going to deal with this is kind of really important for the markets. But the markets aren't there yet. The markets aren't expecting a recession next year. The markets continue to think that there's an upward trend in the economy and earnings, and therefore the valuation is not critically important at this point in time, but it is. So let's look at some of the other cycles here. In 1960, so interest rates went up in 60, we had a recession, and then the unemployment rate went up with the recession. And you can see every single cycle that has occurred. Rates go up, recession, unemployment rate goes up. That's what kills off the inflation rate. So in 2005 and 6, that's the last cycle we've had. Rates go up. Roughly 12 months later, it's kind of odd how it takes about 12 months before the recession actually hits, but that's been historically about the time frame. And then unemployment rate went up quite a bit in that cycle, killed off inflation. Now interest rates have gone up even more this cycle, and we're at the low in terms of the unemployment rate. So we're expecting the economy probably to move into a recession sometime next year about this time, and then that will kill off the inflation. So this is not a good environment when we look out to 2024 in terms of earnings and the outlook for the stock market. Now, we talked about the PE multiple with the 10-year treasury going up. That's going to put pressure on the valuations for the stock market. So how do the earnings look? Well, at this point, we believe they're just a plug number. The analysts aren't focused on it. Maybe their assistants putting in the number. They don't really care too much about 2024 because they have the third quarter to get through and then the fourth quarter to get through. And 2024 will become more important as they get through these 2 quarters. So we think there's more pressure on the $246 in earnings for the S&P 500 for next year. So the expectation this year has been up 2.5% in terms of revenues currently, with earnings being roughly flat with last year. Now next year the expectations are for 5% revenue growth with a 12% increase in earnings. We don't think that's a high probability of occurring, particularly with the odds of a recession occurring next year and the Federal Reserve keeping pressure on the economy by keeping interest rates high. So looking at another issue, we thought we'd been through this already, the government shutdown. So this is deja vu all over again, right? We just went through this. Well, we have the budget to get through before October, otherwise it may cause another shutdown of the government. So it's not good timing as we go into September with the budget process in front of us. It's seasonally a bad period to have to deal with this, particularly if the 10-year Treasury note is rising. NVIDIA reports on Wednesday. The current expectations are $2.08 in earnings, 51 cents versus 51 cents last year. That's $11.2 billion in revenue versus $7.2 billion last quarter. So expectations are pretty high, right? However, the whisper number is around $15 billion in revenue, and the stock trades roughly 54 times next 12 months earnings. So if the company meets expectations, we don't see a lot of upside occurring in the stock market nor the technology sector. However, if they blow the number away, say they hit that $15 billion in revenue, have a big upside surprise in earnings, we think the whole tech group will take off and the market will follow with it for a period of time. If they miss the number, Katie barred the door. Lots of downside in tech, and in particular the stock market will go down as well with it. Thank you very much. Just remember, we are in a seasonally tough period for the stock market. Friday's an all-important day, and then before that we have the NVIDIA earnings on Wednesday. So Friday's going to set the stage for interest rates. Maybe the 10-year Treasury will stabilize if it needs to stabilize here. Please hit like, hit subscribe, come to my website, get Mark in a Minute sent to you, the hard copy with all the stats. My website's Patrick Adams CFA. Take care.